APAC's asset and wealth management industry recently saw fund managers across the region prepare for a new Trump presidency, Singapore steal a march on Hong Kong to become a digital asset centre, Hong Kong alter its capital investment entrance scheme requirements, and China reportedly again ask investors to reduce stock selling. Let's take a deeper look at these, as well as other headlines and developments. Up to Hong Kong. The last day of 2024 saw at least 6 firms announce their plans to list in Hong Kong over January 2025, a sign that the beleaguered SAR's IPO market is reviving. The combined value of the IPOs was 3.3 billion Hong Kong dollars and follow relaxation of IPO requirements for firms listed in mainland China, in addition to CSRC, China's main securities regulator, encouraging firms to list in Hong Kong to further boost its position as a global financial center. Reportedly, several firms wanted to list before Donald Trump's inauguration as President of the USA in January 2025. The potentially strong start to the year carries forward momentum from 2024, which saw IPO values nearly double from 2023 to over $10 billion across 71 listings, though they remain well below the $30 billion seen on average for the 10 years prior to COVID-19. Estimates for 2025 include $15 billion from KPMG, driven by A-share listings by mainland China companies, to $20.8 billion from another Big Four professional services firm. The aforementioned proposed reforms to listing in Hong Kong are seen as attracting more IPOs to the SAR. The changes amount to 9 proposals across open market requirements, IPO pricing and offering mechanisms, and pricing flexibility mechanism. Some of the pertinent changes are a staggered release of the stock held by cornerstone investors, with half eligible after 3 months instead of the current 6. Such a move is seen as making being a cornerstone investor more attractive, especially in volatile markets. Lowering the number of shares required to be issued by mainland Chinese firms listing in Hong Kong to 10% of the total, down from the current 15%, and for the shares to have a value of 3 billion Hong Kong dollars at listing, the current 15% is seen as being too substantial for many companies, especially those with no urgent need to raise capital. The clawback mechanism for retail investors is proposed to be lowered from 50% to 20% if issuers reserve an initial 5% of shares for the public. This mechanism takes effect when the subscription ratio for a listing is above a certain level. It has raised the hackles of investment bankers in the territory, as they believe it leaves them with too few shares to allocate to institutional investors for high-demand IPOs. Whether they and the efforts of Chinese regulators are enough to revive the moribund market in 2025 will be watched with avid interest. Moving on, the Hong Kong Virtual Asset Exchange, a virtual asset trading platform, and Victory Securities, a licensed financial service provider, announced a memorandum of understanding to establish a strategic partnership aimed at enhancing Hong Kong's virtual asset ecosystem. The collaboration aims to explore opportunities across virtual asset brokerage and distribution services, and seeks to combine the infrastructure and virtual asset capabilities of HKVAX with the institutional relationships and digital platform of Victory Securities. Under the MOU, the two parties will explore opportunities in RWA and tokenization, and build a robust ecosystem with the objective of boosting virtual asset distribution opportunities, in addition to providing investors with high-quality, efficiently managed tokenized assets. The signing of the MOU is another development in Hong Kong's burgeoning virtual asset sector. It builds on an earlier MOU signed between HKVAX and Forum Oceano and Yakuba Labs for a Blue Economy STO project, one between Xertrix Foundation and MYEG Services Berhad, with My Capital of Hong Kong to collaborate on the launch of a virtual asset fund, or ETF, and between Value Partners Hong Kong and VentureSmart Financial Holdings to help connect virtual assets with traditional investment vehicles to both retail and institutional investors. Up next, Hong Kong is relaxing the requirements of its capital investment entrance scheme, a step seen as bolstering efforts to attract wealth and family offices to the SAR and elevate its status as a global financial center. From March 2025, investments made via an eligible company, which is wholly owned by the applicant, will be considered towards the program, along with assets owned by family members and family-owned investment vehicles. Prior to the announcement, applicants needed to hold the investments for 2 years, and this has been reduced to 6 months. The Territory restarted the investment program in March 2024 after a hiatus of several years. It allows for those who invest 30 million Hong Kong dollars or more into qualified investments to gain residency in the SAR. The Hong Kong government anticipates the program will bring in over 24 billion Hong Kong dollars, helping its finances amid a falling real estate market, weak economy, and exodus of international firms and personnel. Out of a reported 800 applicants, 240 have fulfilled their investment requirements within 6 months, and the government notes that 733 individuals have demonstrated they have the requisite minimum assets of 30 million Hong Kong dollars. It was also reported that nearly 7,000 inquiries had been received regarding the scheme over the 10 months since its launch. The changes follow others in October 2024, in which single residential properties worth 50 million Hong Kong dollars and up were added to the qualifying investments, though the total contributions from real estate is capped at 10 million Hong Kong dollars. As per a study from Deloitte, a global network of firms providing accounting and consulting services, Hong Kong boasted 2,700 single-family offices in 2023. The CEO of the SAR has a target of attracting 200 large SFOs establishing themselves in Hong Kong by the end of 2025. The announcement follows on from tax concessions on virtual assets and private credit investments for fund managers and family offices that were announced in December 2024, and continues the rivalry and competition with fellow city-state wealth centre Singapore, which has also launched various initiatives targeting the wealthy and family offices in recent times. So, that is this episode's section on Hong Kong. Check out our profile for this episode's other sections, and let us know in the comments if there was an important development that you think we missed and should have been included. Many thanks for watching. Hope to see you next time.